I appreciate it. All right. I got the thumbs up. So I'm on stage now. So thank you so much for kicking us off. Welcome to actually, it's our first housing affordability workshop in partnership with the UCSB alum. Really excited to bring this content to you. As we were thinking about ways to better support our community in home financing, we thought it would be important to kind of design a workshop that can kind of tailor towards some of the struggles that we have in today's housing market, whether you're an existing homeowner or a new buyer, is really around affordability. So our class is going to kind of cover both segments of new homeowners that are looking to buy, as well as for existing homeowners, because now there is talk with interest rates changing, what that looks like for me and my opportunities as a homeowner, again, as far as buying in the market. Well, my name is Jason Maida. I'm going to be your presenter this evening. Thanks so much for being a part of this class. Our run time for tonight's class is going to run somewhere around about an hour, so we'll take you up just about the top of the hour. All of our lectures that we have online are always very interactive. So if you have questions, encourage you to use the chat or the Q&A feature within Zoom. And then I'll be monitoring both of those windows and then answering those questions as they come in. My colleague Ken's also behind the scenes, and he'll be helping take care of some questions as well. Not only this is an interactive session, but we're recording tonight's class, so we'll have it up on our YouTube channel tomorrow. We'll share back with you the links to tonight's recording, as well as all the slides that we present to you this evening too. All right. So that's our plan for this evening. Really excited to go on this journey with you. Again, my name is Jason, and I work for an organization called American Pacific Mortgage. We're a nationwide lender. In fact, we're the 9th largest lender in the country. And our team specifically here focuses on home buyer education or just home financing education in general. So we partner with 15 other universities, just like UCSB alum, to be able to present content like this, usually once or twice a week. As I mentioned, this is a newer class for us. It's going to take some of the elements that we have in our first-time buyer class, as well as some of the content that I teach on in refinancing or for existing homeowners. So there's a lot going on in today's housing market, both from just what's happening with home values, as well as what's happening with interest rates. But at the end of the day, we're all kind of challenged with like affordability, right? Things are more expensive in today's market, whether it's going to the grocery store, fueling my car, whatever power costs, whatever you have, you're facing, affordability is a challenge. So that's why I think this is an opportunistic time for us to be able to share with you in the housing space what affordability looks like or how to prepare us for affordability. Now, as I mentioned, we have two different kind of segments in tonight's class: new homeowners, existing homeowners. So for those that are in class right now, just so I can know where our audience is at, if you can, just put in the chat if you're a new homeowner, so I mean you're a prospective buyer, or if you're an existing homeowner, because I'll spend more attention, depending on how our class is split up, but I may allocate more time towards one area or the other, depending on where kind of the weighting of tonight's class stands. Okay. So whether you're an existing homeowner or a new prospective homeowner, just drop that in the chat. I'll be kind of checking that out. And here's our talking points for tonight. So I want to spend some time looking at the housing market, kind of what's happening. Also kind of share with you as first-time home buyers, like what should we be aware of? So we're going to go through some elements of first-time home buying. We're talking a little bit about credit, which I think is impactful for both sides of our class tonight. We're going to outline some different loan programs that are available to home purchase clients as well as existing homeowners. And then we're going to talk a little bit about interest rates and what's going on with interest rates and why that might prompt you to consider home ownership or maybe refinancing. And then kind of some forecasting for interest rates. We're going to talk about refinancing, which I think even though for a lot of us that are prospective homeowners in tonight's class, it would be good for you to hear a little bit about what it means to refinance and how you should try to really kind of be strategic on when you refinance. We'll talk really briefly about investment properties if any of you have interest around that. And then we'll wrap up tonight's class kind of looking at like, where do we go from here? I connect with clients virtually to help guide them in home buying or refinancing. So I'll kind of give you some next steps after tonight's class, and then hopefully we'll get a chance to get connected with you to provide your own customized home buying plan or just solutions around refinancing. All right, well, let's talk a little bit about the housing market. I think it's impactful for both sides of our class. And as we look at the housing market today, specifically in the California housing market, I know some of you might be joining us outside of California, so we can certainly have that conversation as well too. But we're in kind of the season of the market that it's kind of like flattened a little bit. We are seeing more supply on the market here in the California markets in particular. Now, it's not one of the leaders in supply out there. We're seeing a lot of backlog in inventory, especially in states like Colorado, Texas, Florida, Georgia. Those have the highest supply in the country right now. But California is still high demand, obviously high cost, as we're talking about affordability tonight. But ultimately, we're seeing prices kind of flatten. We're in a kind of a season, if you will, in buying where generally it starts to slow down when we get to about October to probably like February, March. Many parts of the country are slow because the seasons have changed. Like just the weather is colder and not many buyers would want to get out and look at homes in the market. But ultimately, the housing market will cycle with some of those seasons. Now, I do think 2025 is going to be a little bit different because we are starting to see some downward trends in interest rates. And we're going to spend some time tonight, later on in our class, talking a little bit about interest rates and where we see them at and where they're going. I think this is a great time for you to attend a class like this because next Wednesday, the Federal Reserve is going to make a monetary policy update or announcement on what we expect to be is a 0.25% cut to interest rates. That's kind of a foregone conclusion at this point, but we're going to learn more about that next Wednesday. You're going to want to stay tuned in our class because we'll go through interest rates a little bit later in tonight's class. For our prospective home buyers, one of the things we always like to talk about in our full-scale classes, and by the way, we do teach a full-scale first-time buyer class as it's devoted strictly to an hour-long first-time buyer class. We have that recorded up on our YouTube channel, so you can check that out as well. But we also will do other classes like that through UCSB alum. Tonight's, you're going to get some elements of that as part of our discussion tonight. And one of those elements includes our rent versus buying calculator. So when we think about perspectives of owning a home and think about affordability, I think a great place to start is to do some budgeting and thinking about what it looks like for me today in my current rental situation versus what could it look like if I decide to purchase a home, and what are the things that I need to consider around home ownership that maybe I don't realize today in the rental side of things. Now, one of the things we have up on our website that you have access to is some of our calculators, like this rent versus buying calculator. And for tonight's class, I thought I would just walk you guys through a really quick rental versus buy calculator scenario just to help kind of frame up affordability and budgeting when we think about home ownership. And for this session, I wanted to kind of just pre-fill a few of these data points, but I would encourage you when you have some time after class, maybe dive into this yourself. I think it'll help kind of put in perspective really what this opportunity looks like for you in the home buying space. Now, we understand the home prices are at highs here in California, even though we're seeing a little bit of a flattening in the market. So I think a calculator like this will also kind of help you understand like where's the right entry point for you into the market. So if we take a home price, for example, of $650, the minimum down payment for a first-time buyer is 3%. And we're going to talk more about products from a high-level standpoint in just a bit. We have our loan amount that would be 97% of the sales price. And then we have interest rates set at an average interest rate of 6.1. We assume a 30-year fixed mortgage. And then in our projections, we're looking at buying in December. Now that might change obviously for different clients or folks that are in our class, but ultimately your timeline will vary for yourself. But right, we'll put December for the buy date. And then when we put less than 20% down, we are going to have mortgage insurance. And we're not going to talk about mortgage insurance in tonight's class, but ultimately mortgage insurance comes into play when we put less than 20% down. And there's three characteristics that go into mortgage insurance. There's credit score, there's down payment, and there's how much I finance. And so we have in this scenario like a 0.37% mortgage insurance factor. And then we have homeowners insurance, which varies based upon where I'm going to buy in the state or in the country. We have the taxes for my respective house. If I'm going to buy a condominium, maybe a townhouse, I might have HOA dues. And then one of the important things that we have to budget in when we think about what we're going to expect to pay on the mortgage side, or what the benefits will come out of what I'm going to pay on the mortgage, is tax deductibility benefits. And so we're going to plug in a tax bracket for this particular client, which is a 25% tax bracket. We put in the cost of maintaining my home. We have the selling cost. So eventually I'll probably sell my home. So what is that going to look like? We have annual appreciation rates. And then we've had basically the home ownership side built out. Now we're going to put in the rental side. So this is a client that's spending $2,700 a month in rent. they have renter's insurance costs, and they expect their rent to go up 2% on an annualized basis. So when we think about the budgeting for home ownership and then we compare that versus the 2750 I'm paying in a rent, right now, if I was to consider owning a home, I have about a 4-year break even of owning a home versus renting. So after I put in my down payment, after I realize the cost of buying versus my rental situation, I'm going to be ahead of that scenario by buying after 4 years, which is a really, really short break even. But it gets even more intriguing or exciting for us because after 10 years, now I have a gain opportunity of $114,000 by owning a home versus renting. And some of us that are existing homeowners in today's session, I've probably seen that, especially if you bought in the last 2, 3, maybe 4 years, you're seeing those upsides of ownership. So I always encourage clients, while affordability is going to be the spotlight, right? We still want to make sure that we realize that there's going to be some upside benefits in homeownership that we don't see today in renting, namely the tax deductibility benefits and most importantly, home equity appreciation. Equity in growth in that asset is really a game changer for many families. It has the opportunity to really create generational wealth for families. So that is kind of really what the excitement is around home ownership, to be able to have that opportunity. Now, for both sides of our class, whether you're an existing home or a new buyer, credit plays a role in affordability because the better I can improve my credit score, better financing opportunities I'm going to have for myself. Now, every loan program does have a minimum credit score, whether you're refinancing or purchasing a home. So we've listed some of those on screen here for you for tonight's class. Now, as you know, there's 3 different agencies that report out to the credit bureaus, which are going to be Equifax, TransUnion, and Experian. In lending for all products, we look at the middle score of all 3 agencies. So if my highest score is 760, let's say my middle score is 740, and my lowest score is 720, we're always going to take that 740 credit score as the middle score. That even applies to co-borrowers, or if my partner is going to join me on the application. So if my partner is at 700, 680, and 660, well, my partner has the lowest middle score between the 2 of us, which would be 680. So in that case, when we look at that middle score, that could influence my interest rate offering, maybe the product that I'm going to get. Even if I'm paying mortgage insurance, could affect the premium that I pay on mortgage insurance. So when we think about building financing for either home purchasing or refinancing, we want to be very strategic with that because there may be ways that we can customize your home buying solution or home refinance solution by maybe looking at applying with just one applicant or potentially with both. But ultimately, at the end of the day, we look at the lowest middle score between both borrowers. Now, in financing, there are 3 different scores that are available. And there is the credit card score, which is that risk profile. There's auto financing, and then there's a home financing risk profile. And so, of course, when you're doing home mortgage lending, we're going to take that third option, right? I thought I would share with you just our quick score calculation weighting. So you can identify maybe some areas of opportunity for you as you're preparing for home ownership or refinancing, because if we can improve that credit score, again, that's going to improve the cost of your overall financing options. Generally, if we can get ourselves to a 780 credit score or higher, we're going to realize the best options when it comes to home financing. So things like length of credit go into the credit score model. How long have I had my credit file? So the longer my credit score has been available, the better my score is going to be. How much new credit am I trying to get access to? So am I opening up a lot of different accounts in a short period of time? That could negatively impact my score. I really want to avoid hard inquiries on my credit report because hard inquiries can impact the score. Now, there are rules in place in credit scoring that allow you a 30-day window of time to do as much shopping as you want on a home mortgage within a 30-day window, and it's the equivalent of 1 credit inquiry hit to your score. Same thing holds true for auto financing. You can also be able to apply with as many auto lenders as you want in a 30-day window with 1 impact to your score. Now, our team here at APM, we do things a little bit different because we realize whether you're refinancing and trying to strategically time the market or you're a home buyer, we only start with a soft credit check. And the reason why I choose to do that is because we want to make sure we can provide you the financing solutions without impacting your score immediately. Now, once you decide to go forward and ratify your contract on a home purchase or decide to move forward on a refinance, Then we do the full inquiry. But at this point, to understand your options, it only starts with a soft inquiry. Now, 30% is going to be utilization of credit. That's probably the biggest area of opportunity for most home buyers or existing homeowners. It's just how do I push down revolving credit for myself, or revolving balances, I should say. So if I have $10,000 in credit limits and my utilization or balances are at 80% right now, so that means I have $8,000 of that $10,000 credit limit utilized right now, it's probably hurting my credit score a little bit. So my coaching or encouragement to our client would be, let's try to get below $5,000 as our first step. Second step is let's get below $3,000 or 30%. And then optimal is to get below 10% utilization. Now, one of the tips that I always pass along to our classes is to how to manage down the timing of that credit card debt. The credit bureaus receive data from the credit card agencies at the end of your billing cycle date. So once that billing cycle date closes out, the 30 days of previous activity gets posted out to the bureaus. So my tip for our class is to try to pay off or pay down credit card debt before that billing cycle date closes. Because when you do that, you get lower balances reporting out and then much more improved utilization, which should lift your credit score. And then the last component is going to be payment history. That's how I've paid my bills. If you have a late payment, it's rated as 30-day lates, 60-day lates, and then 90+ day delinquencies. Any delinquent debt that you've had, especially in the most recent 12 to 24 months, is going to have the biggest impact to your credit score. Now, we always talk a little bit about student loans in our first-time buyer classes, but I think it's appropriate when we think about affordability in a class like this, because student loans are going to be part of our overall debt load, whether we're a new buyer or an existing homeowner. So the way we have a view on that from a lending perspective is if you're an active repayment, whether it's an income-based repayment or a savings plan, if I have $75,000 in total student loan debt, we're going to take that $250 savings plan payment for your qualifying. Where it becomes challenging is that some of our clients are in forbearance right now, or they're in deferment and not actively repaying on those loans. So in that case, depending on the product, then I would have to assess a minimum percentage of balance as the monthly payment. So if I'm doing an FHA loan, for example, that minimum payment I have to assess with that same amount of balance is $375. If it's a conventional home loan, would be $750. So, we're in kind of this interesting spot right now with, the talk around student loan forgiveness, some people in active repayment. We're seeing student loan servicing rights transfer. So we do have conversations with our clients around student loans because whether we're, buying our first home or we're trying to refinance, that debt obligation can come into the conversation. And the reason why it does is because every loan product does have guidelines that are attached to it. And so when we think about the programs that are available to new and existing homeowners, is that we're going to look at different programs and we have to make sure that that buyer or homeowner is able to qualify for that particular product. So let me give you a quick 10,000-foot view at each one of these products, many of which you've heard before. So the conventional home loan is a Fannie Mae and Freddie Mac loan. That allows a first-time buyer to put as little as 3% down to purchase their home. And there's a minimum, or sorry, I shouldn't say minimum, but a maximum conforming loan limit set by Fannie Mae and Freddie Mac every year right around this time. So last year it was 802,650. It's going to jump up to like 812 for 2026. And then for those of us that live in what we call high cost of living areas, so let's say I'm in LA County, that loan amount can stretch up to $1,209,000. But for new buyers, that minimum down payment jumps from 3% to 5%. And so many of our clients that are considering refinancing, the conventional loan is generally what we're going to utilize because depending on our equity position, we may not have mortgage insurance if we have at least 20% equity position. Same thing holds true for new buyers. If I'm putting 20% down or more, there is no mortgage insurance. Now, FHA is another product option for new and existing homeowners. It is a government insured loan, minimum down payment of 3.5%, and the loan amount varies by the county we're going to buy in. The jumbo loan product is for those that need a little bit more financing that stretches beyond some of the agency limits offered by conventional loans. And so the jumbo loan will generally have higher restrictions around credit score, equity position, or down payment. So it's a little more challenging for our first-time buyers to qualify in that product set, but it certainly is an option for them. I had a question that came in the Q&A. I'm gonna just take it really quick before I go over to the next product. How do you feel about the 18-to-1 rule regarding rent versus buyer? Do you agree with the general wisdom that renting is financially better in the market, in this market is true? Um, I honestly don't know what the 18-to-1 rule is. So I've never heard of that, but please, if you want to provide a little bit more clarity on that. But if your question is really around, is it better to be renting in this market versus buying? That is a personal decision. I think there is opportunity in today's market, depending on what market you're in, because I'm not sure where you reside at. But if you look at what's kind of happening with the housing market right now in certain areas, it's only continued to go up. And I think for those that are choosing to get into this market, interest rates are not ideal, right? But everybody wants the perfect storm of lowest interest rates, lowest priced home. That's very difficult to achieve. Just ask some of the folks that purchased during the pandemic. Interest rates were super low, but guess what? They're getting bid up on homes, $40,000, $50,000. So I think at the end of the day, I think it's gonna be a personal decision. That's why I think consulting with us for a home buying plan is probably a wise thing to do. Whether you act on that or not, at least you kind of understand what the blueprint looks like for home buying. Another question I got was, if married and one partner is a first-time buyer, but the other is not, do we still qualify as a first-time buyer? So it depends on your ownership. If you're married and you live in the home that the person still owns, then you're not considered a first-time buyer. But if that person owned, so the definition of a first-time buyer is someone that hasn't owned a home as their primary residence in the last 3 years. Okay, so hopefully that helps. But if you're married, you live in the home that that spouse owns today, then you're not first-time buyer. But if that person once ago owned, they haven't owned that home in the last 3 years, or that maybe that's an investment property, and you guys have been renting for the last 3 years, then you're a first-time buyer. All right, thanks for the questions. So I want to kind of go down to this product, which is USDA. Both FHA and USDA are government insured products. USDA allows someone to purchase in more of a rural area. You can see the minimum credit scores there, and the maximum loan amounts will be set by county. There are residency requirements on both of these government insured loans, and unfortunately, about 3 months ago, there were some changes to residency requirements. So you do have to be a permanent resident for those products. You can be a non-permanent resident still with the Fannie Mae and Freddie Mac loan product. And then for our veterans that have eligibility for the VA home loan, they can purchase or refinance with zero down or zero equity if you're an existing homeowner. You can see the minimum credit scores. And there's really not a maximum loan amount for our veterans on that particular product. All right, so that gives you kind of a high-level look at what loan options look like for new and existing homeowners. Now, I'm going to speak to our new prospective buyers in California, and because one of the challenges when I work with clients is just saving up for homeownership. We're talking about affordability in today's class, like how do I enter into homeownership? So I think a big part of the equation for homeownership and achieving that in a relatively soon or an early time period versus casting it out 5 years plus is to have the resources of assistance programs. In California, and I think that's where most of us are looking to purchase or our homeowners say, there are resources that are available to you for both low to moderate income buyers. I'm proud to be the #1 partner of CalHFA, which is the California Housing Finance Agency, designed to support that low to moderate income population in homeownership. Some of these products, like the MyHome Assistance Program, provides up to 3% of the sales price in resources for a down payment on a conventional loan, 3.5% for an FHA loan. We essentially create a low interest loan in addition to your first mortgage that's at a 1% interest rate. So if I purchased a home for $600,000, I could get up to $18,000 in assistance at a 1% interest rate. No payments are required until I sell or refinance the home. We also can add on additional resources like the My Access program, which is 2.5% of the loan amount, or the ZIP Assistance program, that's 2%. Those products are kind of interchangeable, but those are ways that we can kind of close the gap when it comes to what I've saved to purchase my home versus what I need to get to, and we can close that margin up with resources like that. And all across the country, there's the first-time buyer programs that are available. Generally, those programs are available for someone that makes 80% of the median income, up to as high in California is 150% of the median income. So if we looked at like a scenario where we were purchasing a home traditionally without assistance, let's say I bought a $700,000 home and I was putting 3% down. Well, that minimum down payment's $21,000. Plus, I have to save up funds for closing costs, which I always generally recommend clients budget 2 to 3% of their purchase price. So probably to purchase that home of 700,000, I'm going to need about $35,000 to $42,000, which for some of us, that's probably a 5-year plus goal, right? But when we integrate assistance programs like CalHFA's MyHome Assistance Program, now I can get $21,000 in assistance now to lower that out-of-pocket expense. Maybe I still need additional resources. That's where a ZIP assistance program could maybe add another 2% of your loan amount. So instead of me trying to figure out how I save in this economy $42,000, maybe I can pull together resources of over $30,000 and make homeownership that much more of an attainable and affordable goal for myself. So that's a quick look at CalHFA, and I've included the guidelines for our class tonight. So we've already talked a little bit about first-time buyers. So a first-time buyer is someone that has not owned a home in the last 3 years as their primary residence. So you could have been renting for the last 3 years in San Francisco and you have a rental property that you've owned for 6 years in New York. You would still be considered a first-time buyer with a program like this. All right. And there are income limits for programs like this. They do go up to 150% of the median income. And that varies by the county that you're going to look to purchase in, not the county that you reside in, but the county you're going to look to buy in. So if you live in LA County today and you're going to move to Ventura, then it'll be based upon the Ventura County income limits. And just wanted to kind of touch on, you're going to see more publication out there in some of your media outlets. We do have a program that we've been working on the last 3 years with CalHFA. You're probably going to see it in the major news outlets because it usually gets broadcast. It's called the California Dream for All program. It has different requirements than what I've shared with you on the My Home Assistance Program and the ZIP Assistance. It is going to more than likely be available for lottery entrants early 2026. We are currently taking new applicants for that. But the lottery is not open yet. Essentially, what this program does, it provides up to 20% of your sales price in assistance or $150,000 that will go towards your down payment or closing costs for your home purchase. Now, the difference is in this program is that this program has a first generational requirement, which basically means all buyers have to be first-time buyers, but one of them has to be a first generational buyer, meaning your parents have not currently owned a home in the last 7 years or at their time of passing did not own a home. We have a lot of details on that on our website. I know we're going to be sending a lot of material to you after tonight's class. We will be teaching a live YouTube class on that program. Again, it's called the California Dream for All program. I'll be teaching that sometime around the middle of November. So if you have some interest there, you can always come check out that class. And we have lots of information, like I said, on our website. All right, we're going to wrap up most of our first-time buyer stuff, and then we're going to kind of go into some of the existing homeowner stuff. But I do want to explain to you the buying process. I think this is probably one of my number one questions I get in working with our clients across the country is like, okay, Jason, I really want to buy a house. Where do I go from here? Well, I think it's smart to attend a class like this so you can definitely learn a little bit more about the important elements of home buying. I would encourage our class tonight, if you have time, maybe check out some of the recorded versions we have of our full-scale 1-hour first-time buyer class. And we'll be hosting more of those in the future if you want to attend a live version. But this kind of shows you what the buying process looks like. So after tonight's class, let me just kind of back up for a second. After tonight's class, let's say you want to get connected with us for a virtual 30-minute session, which is what we do with our clients. Then we'll sit down with you and build a blueprint or home buying plan to home ownership. This kind of shows you visually what happens from there. So you get pre-approved, which is essentially a document that shows that your financing has been validated. You then start your search, whether it's online or in person. And then from there, once you identify a home that you want to pursue an offer on, then you would make that offer with a licensed realtor. If that offer gets accepted, then you move to the enter escrow phase. And then usually from an accepted offer to the finish line, when you get your keys to your house, it takes about 30 days. And you can see these different milestones that we go through in that process. It's a very systematic approach to home buying, but it's one that kind of keeps you completely connected to what we're doing as we move through that workflow. Like I said earlier, if you do want to look at one of our full-scale first-time buyer classes, we go into a deep dive of every milestone, but we stay very connected with our clients while they go through that process. All right, now we're going to kind of pivot now, and we're just over kind of the halfway point in class. Now I want to kind of spend some time talking about what's going on in the interest rate market when it comes to either home buying or on the refinance side. So there's a lot to talk about here. We've been through quite a whirlwind in the last 3 years in interest rates in the mortgage space. Some of which that storm has really kind of pushed a lot of people to the sidelines. It's also had existing homeowners in a situation where they're in an interest rate that doesn't necessarily make sense for them to refinance out of, or it's prevented them from maybe upgrading their home because they've outgrown their home and their interest rate is 2.5%. So now they can't afford to pay a 7% rate and get 500 more square feet, right? So that's the dilemma that people are in, and that's really the impact of the lack of affordability in today's market. Well, interest rates and how they change can obviously impact that. So we're finally on the downside of where interest rates are at. In fact, just 3 weeks ago, we hit 12-month lows in interest rates. I'm happy to report, all based upon what we expected, and what in fact happened was the Federal Reserve cut rates 0.25% about 3 weeks ago. Now, we already kind of knew that was happening, so that pushed interest rates to their 12-month lows. And now, lo and behold, we got another Fed meeting next week on Wednesday. And we have about 100, well, not about, but we have a 100% chance that they're going to cut rates another 0.25%. So we're already seeing the positive impacts of that into mortgage interest rates, that the feasibility of that happening. So interest rates are starting to slide lower, as you can see in our 12-month snapshot here. So we're still right around just above 6% in interest rates. It's slightly higher for refinancing because refinance do have pricing adjustments depending on what your equity position is. But ultimately, we're going the right way in interest rates. Most existing homeowners are trying to wait for interest rates to go below 6% without points. And we'll talk more about that in just a little bit. But ultimately, we're on the right move in interest rates. So interest rates going lower is not an if type of situation. It certainly is a when. It's not an if, but it's more of a when type of scenario. We will see interest rates continue to go lower. Now, as we look at the last 20 years, I just want to kind of show you the cycle of interest rates. Economic challenges like we faced in 08 and 09 with the housing crisis, we still had elevated interest rates. That really wasn't, what was driving interest rates at that time. But when we look at the pandemic and what we faced there, we did see 2.5% interest rates, which is fantastic, but that's not the norm. That was the lowest rates have ever been. And historically, interest rates are generally in the high fours to low fives. That's generally what we see. So to my point earlier, I think I made the comment that everybody wants the perfect storm of lowest interest rates, lowest home prices. Probably not going to happen. But certainly our decision to home buy or to refinance will be dictated by where interest rates are at. Now, every loan program has an interest rate that's set, but it varies based upon these characteristics like credit score and the eligibility for that product, the program that I'm going to select, how much I'm going to finance. If I'm a home buyer, it's going to be how much my down payment looks like. If I'm an existing homeowner, it's what my equity position looks like. And then I do have the option to pay for a lower rate. So if today's rates, let's say, are 6%, but to create affordability for myself, I need to get my interest rate, which corresponds to payment, down to 5.5%. Well, that would cost me additional funds because the market is not there yet. So let's say I pay 1% of my loan amount. Well, let's say I'm financing 500,000, that's $5,000 out of pocket. And if I'm trying to achieve a 0.5% lower rate, it's probably going to take me 2% of my loan amount to get that 0.5% rate. So in most cases, I don't recommend clients paying points because it doesn't pencil out. It usually takes about 3 to 4 years to break even. And in a market like this where interest rates are sliding down, I wouldn't want to put out a bunch of money to bring down an interest rate where if I'm buying a home today, I might consider refinancing in a couple of years. I just wouldn't achieve a feasible break-even point. Now, term of my loan can also change my interest rate. The shorter my term is, generally the lower my interest rate is going to be. So whether you're purchasing a home or you're thinking about refinancing, we're going to be very strategic and work with you in a consultative format to, understand what's the best way to structure your financing for you. It's not just another transaction. We're ultimately going to be a partner with you in making a great financial decision for yourself. Now, I want to jump back to interest rates and what we're forecasting now, because this might trigger some of the timeline that you're thinking about, whether you're purchasing or refinancing. So you can see, projections are showing rates to go below 6% at the end of next year. That's a TBD situation. We'll have to see where they go ultimately. We're seeing a little bit of a could interest rate spike a little bit in the latter part of the year. I don't know if I necessarily believe that forecast from Fannie Mae, but I think we're going to probably stay around this course right now until we get to the bottom of 2025. It really is hinging a lot on what the Federal Reserve does at the next two meetings and what we're going to get out of that, because that will drive kind of where we close out 2025. I do think we'll probably have a chance of reaching sub 6% in first quarter, maybe second quarter of next year. I don't think we're necessarily going to have to wait that long, but this is a very interesting economy. It's a global economy that we work in right now. In our industry, interest rates change by the minute. So, things might look different at 8 o'clock Pacific time than they do at 1 o'clock Pacific time. So it just really just depends on how the market is fluctuating. And of course, in this geopolitical environment too, there's a few things that are moving around here in the markets that can also really kind of take things off course, so to speak. All right, so that's kind of a look at interest rates. Now I want to kind of switch a little bit. I want to talk more to our existing homeowners, but for our first-time buyers, I do think this is important stuff when you think about affordability. And obviously you have an entry point to homeownership now, but the next step is to increase cash flow, increase affordability in your home as an existing homeowner when it makes sense to refinance. So when we think about refinancing, there's a few reasons why you would want to do it. One is decrease your interest rate, obviously, which translates to reducing of the monthly payment, reduce your term. Maybe you want to pay off your loan a lot quicker. Some clients maybe have a debt that they've taken on recently, and now they want to kind of leverage home equity to pay off that debt. You can do that as a homeowner. And then sometimes you may take out a line of credit in order to also access equity, pay off debt. Maybe you're funding education for kids. Maybe you want to do some home improvement. Maybe you want to put a pool in. All those things can be done by leveraging home equity. Now, when you're thinking about refinancing in general, the reason our general kind of logic that we apply is we generally want to see at least a 1% reduction from your current rate to your new rate. So if my rate today is at 7.625% and the market is at 6.25, well, that should be a win. I should definitely go for that. And so, that would make sense for us. But if I'm at let's say I'm at 6% today, the target rate for refinancing is 5%. And so that would make a lot of sense out there. And unfortunately, in today's market, I do see a lot of lenders preying on consumers to try to stimulate refinance activity, which is really unfortunate. Even as an existing homeowner myself, I got a text message today from a lender, proposing something that was totally unrealistic in the market. And so I would just say, as a word of caution for everybody, whether you're refinancing or purchasing a home, there's a lot of clickbait out online that shows ridiculously low interest rates. Like you maybe see a rate of 5.25%, but until you look closer at the fine print, you realize that those discount points we talked about earlier are not being displayed or disclosed properly to you. So unfortunately, a lot of that happens, and it really obviously deteriorates trust in the lending community when you have offers like that. But in our world, the way we work with clients is very transparent, and we're showing everything without points, because ultimately, to my point earlier, like there doesn't make a lot of sense to buy points in today's market. And so you will see lenders offer ridiculously low rates that just aren't achievable without paying additional expenses out of pocket. Now, I want to talk really quickly about investment properties, because I do get a lot of questions around, house hacking and, how do I refinance my home and, maybe add on an ADU or do different things. So I do want to just quickly interject some information on investment properties, because I do think that kind of like plays to affordability, right? Because some people are trying to buy 2-unit properties, rent out one unit, live in the other unit, and that's their way of house hacking into the market. So, however, when you purchase an investment property, it's generally, and you're a first-time buyer, you're not going to be eligible for first-time buyer assistance programs. It usually has to be a 1-unit property. Not to say you can't purchase an investment property, but generally you will lose assistance options. On a conventional loan, when you purchase a multi-unit property, 2 units or more, all the way up to 4 units, it's a minimum down payment of 5%. Of course, we're going to be putting less than 20% down, so it is including mortgage insurance. And on an FHA loan, it's 3.5% as your minimum down payment from a 2-unit to 4-unit. Now, any property that stretches beyond 4 units is going to be a commercial property, which is not eligible for any of the products we're speaking of. So, buying a multi-unit property, or if you're an existing homeowner and you have a multi-unit property, you understand there's certainly some opportunities there. But I think, as we're considering homeownership or crafting affordable solutions in general for ourselves, investment properties can be a vehicle to that. The one thing I will say too with investment properties is that when you do an investment property on the financing side, interest rates can tend to be a little bit higher as well too. All right. So a question came in is, what does the process look like to take cash out from your home equity? There's a couple different vehicles to getting home equity out. You can take out that home equity by refinancing your home. And so let me give you an example here. So let's say my house is worth $800,000 and I owe $500,000 on my house. So technically in a cash out refinance, I can take up to 80% of the $800,000 value. So that would take me to 640. I could do a loan amount of 640 minus what I owe on the house. Then I would get that cash out in equity. It would be a normal lending process, but ultimately we're going to basically fund that into your first mortgage and then distribute that cash to you as part of the closing of the transaction. Now that's one way on a refinance. You can also tap into home equity through lines of credit, which HELOCs or home equity lines of credit or installment. They're basically second position loans on your house. Now, you can do that, and generally most people will consider doing that because they have a really super low interest rate on their first mortgage. Maybe it's 3.5%. They don't want to disrupt that at all. So then they'll tap into a home equity line of credit or a second mortgage on their house. All right, thanks for that question. That's a good one. Now, if you're thinking about consulting with me to kind of look at your options, whether you're thinking about home buying or you're thinking about kind of redesigning your existing mortgage, or to that other question we had, like you're trying to tap into home equity, I would love to be able to connect with you for a virtual consultation. So that's a 30-minute session I do with all clients, whether it's a home purchase or a refinance, so we can figure out what your options look like. It starts with our get started information here, which you can see like a really simple online application, a soft credit check, which does not impact your score, and then you'll upload appropriate documents and then use our scheduling system to schedule the consultation. For our refinance clients, we do have a specific scheduling tool for that, or not a tool, but it's one of our options, if you will, in our scheduling site. But whether you're purchasing a home or refinancing, it's still a very in-depth conversation that we want to have with you to make a good financial decision. I think that's one of the differentiators for our team here is, we understand these are big, major financial moves that you're making. And so it's not a transaction for us. It truly is a relationship that we want to work with you for, and we want to partner with you. Many of my first-time buyers over the last several years are now having conversations with me about refinancing. And so part of our aftercare is we're always managing and watching the market to make sure that you're in the best financial position. So this is what a consultation looks like for us as new buyers. It'll look a little bit different on the refinancing side because some of these things obviously were not applicable for what you're trying to do. But at the end of the day, we're talking a little bit about, what does our budget need to look like for the refinance side of it? What are interest rates look like? That's obviously interchangeable. Closing costs, we're looking at expenses versus income and outlining the process for you. All the really important elements to whether you're home purchasing or refinancing. Now, whether you're doing the refinance or the home purchase, we also pass along a discount program. So as part of our partnership with UCSB alum, we discount our services by $750 as part of our financing work with you. And, we do have other partnerships across the country. Of course, our UCSB family is our favorite right here in our own backyard. But, if you do have friends, maybe family, coworkers that think would really enjoy some of this content, we love for them to kind of check out some of our future classes. This again is our first kind of test in the waters of affordability and taking some of the elements of our home buyer class and merging those into some of our existing content that we have for existing homeowners. And so hopefully you've enjoyed this information. I've enjoyed bringing it to you, and it's really I think important for us in today's market where things are just much more expensive and we're considering major financial decisions like this. Hopefully, tools like this will help you kind of make sure that you have more clarity on making that decision. Here's all my contact information. So if you do have some questions or want to follow up after tonight's class, I encourage you to get connected with me. Again, this is a relationship we have with our clients, and I think our socials kind of speak to that as well. So we have a lot of great experiences are shared there, some of which come right from the Gaucho family that we've helped purchase homes, whether it's in Ventura County or LA County or up in Northern California. And we love what some of our Reddit community also says about us too. We understand, the value that we play in the role of affordable home ownership for our communities. And so we'd love to have you check out what our communities say about us there too as well. So with that being said, I know I've taken some questions through our class. I still have the whole class hanging on, and we have a few minutes still left. So before I turn it back over, just want to take a few more questions from the audience. And thank you for the comment in the chat. Appreciate that. So any questions from our group here? I know we're getting a little bit, I promised you an hour-long class, so we're trying to figure out our timing since this is a new class for us. We'd also welcome any feedback. So if there's, things that you guys think would be helpful to your fellow alum that we can bring to making and improving this class, we welcome the feedback. We are recording tonight's class, so it will be available and up on our YouTube channel. So I think that's a question that came up. And then we do have all of our other classes that we teach all across the country up on our YouTube channel. And in case you have some interest in that CalHFA Dream for All program, that live YouTube class, we'll be sending out some information on that. That'll be available to everyone as well. Okay. So a question came in, which is, I don't think I'm gonna be ready to buy for the next maybe 4 to 5 years. Would it be beneficial for me to meet with you and the team just to get a better understanding and build a plan roadmap to purchasing? 100%. I think that's the way to do it. There's no really time constraint or timeline that once you meet with us for a consultation, it's not like we're meeting today and you're going out and buying a house this weekend. This is a kind of a home buying plan. This is a blueprint to home ownership. Allows us to set some goals and objectives to home ownership and understand affordability for yourself. So yeah, I meet with clients all the time, that are still maybe 1 to 2 years out from home buying or longer. The average kind of cycle time for most buyers is like 6 to 12 months. Do you work in the LA area or are you exclusive to Sacramento? This is just my hub here in Sacramento. I work all over across the country. So we're a nationwide lender. And all of our work we do with all of our communities that we serve are all done virtually. We love to meet with people in person too, which we certainly do that. But virtual seems like that works best for our communities that we support. So. Of course, I would love to be meeting everybody on campus at UCSB. That would be much better. I think that would be we can plan to do that. So that would be a much better environment from my perspective. But yeah, most of our clients we do meet with virtually. All right. Any other questions from our class? Okay, well, you guys have been a great audience. Thank you so much for being a part of our first affordability homebuyer workshop. Again, I would welcome any of the feedback that you have, that we can help improve this for our local communities. Because again, we do understand the challenges that everyone faces. And I know home ownership, whether you're an existing homeowner or a prospective home buyer, it is a huge goal for all of us. And we'd love to be able to partner with you on that journey towards achieving those goals. All right, I will go ahead and turn it back over. And we'll get it wrapped up, or maybe I'll close out. We'll see what we want to do here. I think maybe I'm closing out. Okay, I'm closing it out. Okay, so to that end, have a good night, everyone. We'll see you soon.